Okay. So next, what is credit risk in banking? Here, specifically to banking, for banking we are talking now. What is credit risk in banking? Here, when we talk of banking, banking relates to three types of risks. In credit risk, there are three types. I'll come to that. Firstly, understand the concept of credit risk in banking. Credit risk is the potential loss of a bank may incur if the borrower doesn't pay. Okay? Doesn't pay. Now, this already we have covered just now. That doesn't pay. Borrower doesn't pay. One. It can also refer to the risk that a bank's investments may lose value. Investments may lose value means bonds. That also I have covered just now. Bonds. Credit risk can arise from variety of bank activities including lending, investing and trading. Now lending, investing and trading. Lending, investing and trading. Okay? This one. Lending, investing and trading. Now lending and investing we have just now covered. Lending means I'll give you a loan, you default. Or I'll give X a loan. You means you'll say always, sir, we won't default. We are not that bad guys. You means just an example. Okay? I'll give, let's say, not you and me. I'll give X a loan and that X defaults. Otherwise you'll say, sir is always blaming us. You. It's just an example. Okay? So I'll give X a loan and X will default. Similarly, investing, I'll purchase the bonds of X. See here, what is investing? Kindly understand this concept. I'll purchase the bonds of X and give him money, FD, and then that X will default. What is this trading part? This trading, this one. Trading. Trading means it is similar to investing only. See here, what is the difference between trading and investing? Slight difference. Trading is for shorter period and investing is for the longer period. Otherwise, logic is same. Trading means what? It's purchasing the bonds only. Bonds or shares or anything. Any instrument of other person. That is basically purchasing it. That's it. So in trading also, same risk will be there as investing. Because if I purchase the bonds for trading, there are two books in banking. Kindly note. There are two books. Which are the two books? One is banking book. Banking book. Banking book. And second one is trading book. Trading. In banking book, this question definitely comes in exam. Banking and trading book. In banking book, we purchase the bonds for CRR, SLR, compliance purpose. Compulsory. We hold the bonds till maturity in banking book. Whenever we purchase it, now we hold the bonds till maturity. In trading book, it's not the case. In trading book, we purchase the bonds so that we can sell. Because after all, we are here for business. We are not only for compliance. Compliance is one part. You have to do your business also. Right? So, in trading book, we purchase the bonds for selling. One and the same thing. I'll purchase some bond from somebody for selling. Tomorrow I have to sell. But today that person defaults. What to do? So that is basically the problem. So investing and trading, logically remember both are same. Only duration changes. Time duration changes. Okay. So coming back to this point. Credit risk can also be affected by country specific, country specific, economic, political or social events. Economic, so you have heard some word. Can anyone type in the comment section? What is that word we use in any countries, checking the any country's position as such? Which is that word? Let's count 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. How many of you answered this? Some of you. See this, pestle. P-E-S-T-E-L, pestle. Political, economic, social, technological, environmental and legal. These are the 6 parameters on which any country or any project is always judged. So any country condition, if you want to check this pestle. Same thing, look at this. Political, P. Economic, E. Social, S. T is technological. That's not mentioned over here. So TEL is also there. Technological, environmental and legal. Nowadays here, Environmental is also there, legal, but these are secondary. Primary are these, even technology is secondary. Primary are these three. Political, economic and social. Very important. You see, any country has failed because of political issues and social issues. Take the latest examples. Bangladesh. What has happened to Bangladesh? Why? Social issues, uprising, political issues. Economic is obviously there. Call it Pakistan. Same. PES. Political, economic, social. Sri Lanka. PES. Same thing is going to happen in some other countries also now, because this year it seems is going to be a topsy-turvy situation or turbulent situation. Okay. So coming back, that's not right now. You have to clear your CIIB. Okay. So the point over here is this PES is always checked, or you can check it full PESTEL also. Remember it PESTEL throughout your exam period at least. So what are the three types of credit risk? Three types of credit risks are firstly default. Okay. Second is concentration. This one, concentration. And third one is country. Okay. Default, concentration and country. Default I have already explained. Country I have already explained. So remove them. 1, 2, done. Concentration. What is concentration risk? Concentration risk means I give the loan completely to IT industry. All IT. Take Infosys, take loan. TCS take loans. Wipro take loans. Persistent take loans. ABC take loans. Come this take loans. You take loans. X take loans. IT, you are in IT, take loans. If I give a loan like this to specific only IT industry, and tomorrow if the IT industry cycle goes down, all the IT industry is down, then what will happen? My loans are flash. Right? From year to year, zoom. Right? Down. And my bank, down. Shares down. Isn't it? So that's why we should never ever focus on concentration. We should never have a concentrated loans. Okay? Never ever have a concentrated loans. We must always be having a diversification. Important is always diversification. Diversify. Don't put all the eggs. Not eggs, man. Why do I say eggs? Be a vegetarian. Okay? That's good for health. Veg is good for health. How many of you agree? Type in the comment section. Veg is good for health. How many of you agree on this? Human body, as per biology, human body is made for vegetarian food only. Kindly note. You can check it on Google. Many of you will argue, sir, what are you saying? Forget it. That is the basic. Okay? So coming back, don't put all the onions in the same basket. Don't say eggs. Onions in the same basket. Okay? Don't put all the onions in the same basket. Diversify. Give some loan to IT, give some loan to steel industry, give some loan to FMCG, give some loan to white goods. White goods means all TV, etc., television, all these things. Okay? So, concentration risk is a major risk in banking. Okay? Next. How is credit risk managed? Now you got understood what are the types of credit risk. One is country, default and concentration. So how do you manage them? Once you know the problem that yes, I have fever, so I'll take the medicine for fever. Once I know I have some leg pain, I'll take the medicine for leg pain, isn't it? Bank uses credit risk management to assess borrower's credit risk and mitigate losses. Check the borrower's credit risk. Means borrower risk means what? If I give the loan to this person, what will be the risk? How much will I lose money? That is always checked. How do I check this? Through ratings. Who gives the ratings? Ratings. Who gives the ratings? The ratings are given by external agencies. Who are external agencies? 1,000 questions arise. As you go on answers here, always try to answer 5 who's or 5 how or 5 why to any problem. You'll get the real answer. Okay. So, who gives the ratings? This external agencies, CRISIL, ICRA, Fitch. Okay, these are all the agencies. CRISIL, ICRA, Fitch, then S&P, Standard and Poor's. They give the ratings. They give the ratings to the countries also, to the companies also. All the loans beyond 5 crores in your banks have to be rated externally. Kindly note. Okay. So assess the borrower's credit risk and mitigate the losses. Mitigate the losses means reduce the losses. How do you mitigate the losses? How do you reduce the losses? There is number one, take the collateral from that customer. If you take the collateral and the loan defaults, then what happens? You can directly sell that collateral, number one. So number one, I'll give you, where is it? I'll write it over here, collateral. Collateral. Number two, buy the derivatives. Derivatives can be bought, no? Derivatives. Derivatives is a separate topic. We'll cover it in module C. What are the various types of derivatives? Buy the derivatives. There are various types of derivatives. Options are there, futures are there, forwards are there, FRAs are there, swaps are there. Okay, you can have 1,000 types of derivatives. Okay. In swaps also there are various types. TRS, total return swaps. CDS, credit default swaps. Generally, every exam you will get the CDS and TRS question. I'll teach you when the topic comes, not now. Okay, so you watch this series. That's what I'm saying. Watch the series always. Okay, so move on. So mitigate the risk. Mitigation is done through either collateral or derivatives. Now there are two ways here. Again, I'll go a bit deeper in this mitigation. Mitigation is done at two levels. One is at the HO level, second is at the branch level. At the branch level, you can take this collateral, branch level. Okay. At HO level, you can take these derivatives. Also at HO level, you can diversify the loans. Diversify means, just now I told you, some to this 1,000 onions. Remember that? Onions in the same basket. Don't put it in the same basket. That is done at HO level. Portfolio analysis. So coming back, mitigate the risk. Second is, banks may perform credit checks on borrowers. Credit checks means again ratings on the borrowers. Borrowers ratings will be done through all these, again the same companies. CRISIL, ICRA, Fitch. For retail we have CIBIL, Highmark, right? Plus the Experian. There are 4 companies, no? Yeah. So all these give the ratings. On the retail we have these CIBIL companies, or we call it credit information companies, CICs for retail. And for these corporates we call it CRISIL, means credit rating companies. So credit checks on the borrowers and require insurance or seek security over assets. Security over assets means collateral. Okay, you ask for collateral. So this is the way you can reduce the risk. Already this I have told you, at the branch level, at the HO level, 2 separate levels are there. Okay. Next, banks may also use credit software, risk software, to help manage the risk. Obviously. Now, will you do it manually? Anything? Huh? How many of you work manually in the bank now? No one. Without computer software, you can't work at all in any bank. By bank, any organization, you can't work. Simple, isn't it? So, this is the way you can manage the risk. What is country risk? Country risk means basically, see this. Just now I have discussed pestle. But what is the definition of that from the exam perspective? Country risk is the risk that a bank takes when it operates in foreign country. It's a type of systemic risk that can't be avoided. Can't be avoided. Okay? Systemic, what is systemic? Systemic risk means failure of the entire system, banking system, due to the failure of the single bank. Lehman Brothers, 2008. Lehman Brothers. All the banks failure. Okay? So systemic. Got it? Then that can't be avoided. You can't avoid this. Why can't you avoid this? Here, I can take a risk on some XYZ company or XYZ country. At that time, the rating is very good. But over the time, or in one night also, many times it happens in just 1 or 2 nights, everything is gone. Bangladesh. Just in 1 week, the whole Bangladesh was gone. 1 week. So this is how the things happen. The rating changes. Overnight it changes. You can't avoid it. Okay? What it's affected by? Country risk is affected by economic, social, political conditions and events in the foreign country. Obviously, isn't it? Pestle, just now we saw it. How it's managed? Bank can manage country risk by establishing systems and controls to manage the risk of their international activities. You can give a limits here. In when I was in one of the foreign banks, Citigroup, when I was working in Citigroup, we had limits to the country also. In fact, all of them now also everyone has it. Limits to the country means I want to give the loan. Let's say there are many buyers from USA. So I'll limit to certain extent. Beyond this, I can't give. Let it be any good buyer. I can't extend the country limit. If $100 loan is totally allocated to the country, so I can't go beyond 100. Up to 100, whatever is there, I can give it. That's the basic limiting. Okay. There are two limits in any banks. One is country limit, and second is counterparty limit, party limit. Individual party also there are limits. You can't give beyond so and so amount. RBI has also given it, because your retail loans also or your corporate loans also, you can't give beyond 10% of your this tier 1 capital, isn't it? No, 10 or 20 it is, 20%, not 10. It's 20% of your tier 1 capital to the individual. And if it's a group, then 25%. Same is over here for Forex also. Okay? So this is how you will be managing. Now it's your time to answer. Let me see the questions. Read it? What is the answer? Here, I'll read it. The credit risk assessment exercise should be repeated biannually, annually, once in 3 years, none of the above. So credit risk exercise should be repeated how many times? Means, should I repeat for all? See, what do you mean by credit risk exercise? Checking all the loans, their collaterals, their risks, their issuer risks in bonds, checking the issuer's risk ratings. That is checked over here. So it should be repeated how many times? Is it biannually? Means once in 2 years. Biannually means what? Once in 2 years. Is it so? Or is it annually, once in a year? Or is it once in 3 years? It's obviously 3 years over here. So what is the answer? Biannually, annually, or once in 3 years? Or none of the above? That can also be the answer, none of the above. Yeah. What is the answer? It is annually. Every year you have to do it, every year, because that's what you are paid for. I'm in the bank because I have to do this credit market ops risk analysis every year. That's what I'm paid for. If I don't do it, then out, ghar, chalo ghar. Isn't it? Now banks are very professional in your life. Kindly note, banks have become very professional. Let it be nationalized bank, let it be private bank. Either you perform or you perish. Perish means out, perform or perish. This is a new term in banking. Perform or perish. Bank wants knowledgeable workers. Knowledge workers they call it. Bank wants that. Perform or perish. You either give the performance or you are chalo, bahar. Okay? Which of the following statements about the credit spreads are correct? Credit spread. Now credit spread means it is related to credit risk, but basically it means what? It means NII, net interest income. Which of the following is true regarding this NII? The pricing of the credit is done on cost plus approach, that is benchmark rate plus spread. So pricing of the credit is done on cost plus approach. What is cost plus approach? Cost plus means we decide a benchmark first. Now what is the benchmark? Let's decide. Let's look at it. What is the benchmarks here? There are two benchmarks. Okay, two benchmarks. Which are those? One is external EBLR, external benchmark lending rates, EBLR. EBLR, external benchmark lending rate. Second is IBLR, internal. IBLR. What is this? EBLR. EBLR has two benchmarks. Okay, EBLR has two benchmarks. Type it. Who knows it? EBLR has two benchmarks. Which are the two benchmarks of EBLR, external? Let's count 20 now. It's a difficult question. 1, 2, 3. I'll count. You give the answer. 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. What is the answer? Comments, everyone. Here I come. Okay. So it is EBLR. EBLR is of two types. FBIL, Financial Benchmark India Private Limited. It's PL. FBI PL it should be, but we call it FBIL. FBI PL it is. Financial Benchmark India Private Limited. It's a company which gives the benchmarks. These benchmarks, this company is owned by RBI. Totally owned by RBI. 100% owned by RBI. So RBI owns this. So one, this company gives the benchmark. Second, RBI itself gives the benchmark. RBI gives the repo rate, right? Repo. RBI gives the repo rate. So these are the external benchmarks. Okay. One is this FBIL and second is this RBI. Okay. FBIL, kindly note, this question comes in exam. FBIPL actually. FBIPL, Foreign Benchmark, Financial Benchmark India Private Limited. So these are the two benchmarks, FBIL rate and RBI rate. More on this later in module C you are having it. So internal benchmark. Internal benchmark is nowadays mainly related to MCLR. Okay, it is related to MCLR, marginal cost of lending rates. What is this? You have heard about this MCLR? How many of you have heard about this in the banks? MCLR? Give me the answer, chalo, in comment section. What are the components of MCLR? Fast. Jaldi. Yes? You know that Donald Trump's dance? Jaldi. I always remember this dance. This guy has changed the whole world, right? What a majority he got. This was his dance, no? This. Donald Trump dance. It has become very famous, huh? So MCLR, what are the components of MCLR? The components of MCLR are here, very simple. MNOP. MNOP. ABCD, you know? ABCD, EFG, HIJK, LMNOP. M is marginal cost. Marginal cost. Now I won't write the full thing now. Marginal cost. N is negative carry on CRR. Negative carry on CRR means where I don't earn any interest. When I invest in CRR, do I get any interest? Do I get any interest when I invest in CRR? No interest. Okay? So I don't get any interest in this. So that is negative carry. O is operating cost. Operating cost means your all salaries. You all are working now in bank. Operating cost. So operating cost. Okay, salaries, all your salaries. And P is tenor premium. This is very important. Tenor premium. Tenor premium. Remember this. Tenor premium. Very important part about tenor premium. It is the tenor premium is related to loans which are tenor premium is related to loans which are of long-term duration. The loan should be of long-term duration. If I give the loan of 3 years, 4 years, no tenor premium, nothing. If I give the loan for 10 years, tenor premium. More than 10 years, you'll say, sir, we can't give more than 10 years. What are you saying? I agree you can't give. But if you take the special permission, you can give. Special permission, with special permission you can do anything, and why not? Why not? If I have to build a dam, good dam is to be built. This road construction right now going on, NHAI, whole highways like butter, right? Isn't it a development? So banks can give here. Normally you can't give. 10 years is the maximum limit. But if you take special permissions, then these are allowed. So coming back to this point, when you give the loans of the higher tenure, in that case you have this MNOP tenor premium. So coming back to this point, pure year, cost plus. So see this, just one word, so much description came into it. Yeah, point is not answering. Only answering is not the question. This question may not come in the exam or may come in the exam. Anything is possible. You must know the basics. You got this point over here, EBLR, FBIL, REP, RBI, IBLR, MCLR, MNOP. This you'll remember it throughout your life. Now the question can come on this also, can come on this also, can come on any of these also. Anything the question can come. So in one question we have covered so many topics. This is what is required. Because nobody can guarantee I am taking 10 questions. Will these 10 questions come? I don't know. But the explanation in that will be definitely useful to you. Okay? So where were we? Pricing, cost plus benchmark plus spread. The spread comprises various factors that include product specific operating cost, credit risk premium. So it obviously is that spread comprises product specific operating cost. Means whatever here, MCLR is generally taken for product level. Many times each product has different MCLR. Many times each product, home loan has different MCLR, then a personal loan has different MCLR. Many times this can happen. So product specific, and this spread is also decided on the product. What is the risk level? It's decided on that. Next, business strategy is component of spread under MCLR system. So business strategy is component of spread under MCLR system. So that is also correct. Okay, component of spread. What is the spread you are taking? So all 1 and 2 and 3 are correct. But what about 4? Let's see the fourth one. The spread component can be negative in MCLR. The spread component can be, let me remove this all. Now you have got it, everyone. The spread component can be negative in MCLR. This is false. This can never be true. This is false. Can you give the loan like this? Repo minus 2. Can you give the loan like this? Or MCLR minus 2. Can you give it like this? Not at all possible. Right? It's not possible. So you have to give the loan this. If you want to give it minus 2, then why not to reduce this MCLR by 2? If my MCLR is let's say 8% and I am giving 8 minus 2, 6. So reduce that MCLR to 6. It's that simple, isn't it? So this is not possible. So the answer is only 1, 2 and 3. B is the answer. Okay, got it? Dash applies to any financial instrument that are denominated in currency other than your own. Currency other than your own. Okay, I'll add one more option in this. A, B and D. Look at this, one more option I have added. So dash applies to any financial instrument which that are denoted in the currency other than your own. Means I am having in rupees. So I purchase a bond which is in dollars. So which all risk will apply to this? In that case, see, this country risk will apply because dollar is a currency of USA. Credit risk will apply. If tomorrow something happens to USA, then what? I am in trouble because I have purchased the bonds. Nobody will pay me. Of course, very less chance. But after all, risk is risk. Reinvestment risk, forget it. This is not a part. Reinvestment risk is different. Means, what is reinvestment risk? If I purchase a bond right now, after 3 years, if I want to repurchase it, means maturity, then repurchase. Then will I get the same rate? So that is out. Okay. So that is not related to this, any of these risks right now. Concerned with this. Foreign exchange risk, obviously it's there. Suppose if the dollar rate tomorrow comes down, goes up, obviously my value will be affected. So what is the answer in this then? How many of you got this answer right? Let me see. How many of you got this answer right? Let me see in the comment section. Yes. The answer is E, A, B and D. A, B and D. This is the answer. All the three risks are involved in this. Okay. The credit risk of bank's portfolio depends on which of the following factors. So credit risk depends on which of the factors? State of the economy, trade restrictions, inadequately defined lending limits for loan officers and credit committees. Inadequately. Now check this. You have to answer this. You have to answer. Very simple one. I have already discussed pastel. So now answer this. Yes. What is the answer? Yes, comment section. It is all the three. Okay, all of the three, A, B and C. Okay, because pastel, state of the economy, trade restrictions, political, P. State of the economy, E, PE. And this is internal. This is not related to pastel. This is internal. You don't fix the limits. Who is to give what loan? You don't know. Branch manager has what powers to sanction? You don't know. Definitely there will be chaos. Right? Credit risk will definitely arise over here. Okay? The management of credit risk process should encompass which of the following? So credit risk, if I have to manage, it should encompass which of the following? Encompass means what? It should have. It should have which of the following? Measurement of risk through credit rating scoring. Measurement of risk. Should it have measurement of risk? Quantifying the risk through estimating expected loan losses. Quantifying the risk. Quantification. Quantification means finding the, means what is the expected loss. We call it actually EAD, exposure at default. Okay. So quantifying. Third is risk pricing on random basis. What is random basis? Many of you got this 2 correct, right? 1 and 2 you got it correct. 1 and 2 is okay, you said. Many of you might have got, by now you might have got this A and B correct. Only C is the problem now. Many of you will say random means what? Random means very simple. What does the auditor do? Whenever he comes to the branch for the loan processes, many times what does the auditor do? He takes 10% of the loans as a sample. 10% random. If there are 500 loans in your bank, he'll take 10%, 50 loans. One this, other that, there, something like this. Any file he'll pick up. Okay, that is known as random basis. But that is not allowed. Kindly note. If you do this credit risk on random basis, then you are in a problem. You have to do it for each and every basis. Systematic basis you have to do it. Systematic. Okay? You can't do it on random basis as per your wish and will. No. Okay? So in that case, this answer is wrong. Random basis is wrong. Two are right. So A and B is the only answer. A and B. Got it? Credit risk or default risk involves inability of or unwillingness of a customer or a counterparty to meet the commitments in relation to. So credit risk or default risk, inability or unwillingness of the customer to meet the commitments in relation to. So what are the relations? Means, is it related to lending loans? Is it related to hedging? Is it related to equity prices? Is it related to both A and B? A and B means these two. Are equity prices involved in this? In credit risk? Commitment related to equity prices. So the answer is actually these two, lending and hedging, A and B. Lending means I give you the loan, you don't give it back. Hedging means again the similar, I purchase the derivatives from you, derivatives, and then you don't pay it back. Derivatives I purchase and then you don't pay me. Means I'll buy the insurance from you and then you'll say no insurance. So that's why this is, both of them are the answers. Okay? Now before going, everyone, kindly note, join the paid batches ASAP. Immediately join them. Just now they have started. Okay? Let me show you. Go to Atta 24/7. Always go through the app. Kindly note, always go through the app. Okay, in the app you will be getting 1% extra using the coin systems. See this. Click on JIB and CIB. Done. Click on this CAIIB 25 June. Okay. Bonus batch. Click on this bonus batch. Okay. E-books, mock test, online live classes. E-books and mock tests are to the level of chapter wise. Per chapter you are having e-books and mock tests. What all do you want? At what cost? Recorded videos. This compatibility, device compatibility means what? You be on any device. Okay? You'll be able to use it. At what cost? Look at the cost. Click on buy now. Put the code Y432, Y432, Y432. Okay? Okay? See this, 80% off you are getting, 80%. Plus 1% extra using the app. So use 81% off discount. And if you buy the Mahapack, in Mahapack you are getting multiple batches per subject. Okay, in Mahapack, you are getting 15 plus batches per subject. So go for the Mahapack also. Okay. See this, CAIIB Mahapack 2.0. 15 plus batches per subject you are getting. Plus you are getting electives also over here. Marathons, all the marathons are available over here. What all do you want? Buy immediately. Okay? And double validity offer is going on right now. Double validity means you buy for 6 months, you get it for 12 months. So immediately do it. Okay? Use the same code, Y432. Okay? Chalo. Bye from my side for today.